Welcome to the deep dive. So, you've given us this really interesting set of information today, zeroing in on 5 specific stocks and where they might be headed.
That's right.
And our mission really is to dig into this data, the performance, what experts are thinking, the technical stuff, and just try to make sense of it all for you, the listener, give you a clearer picture of these potential investments.
Exactly. We're looking at SBEV, that's Splash Beverage Group, STAK Inc., Bull OL, which is Webull, XAGE Longevity Health Holdings, and VRO, Venus Concept.
Okay.
And just a heads up for everyone, this info is current as of April 16th, 2025, around 3:47 p.m. Pacific. Stock markets move fast, so this is a snapshot in time.
Definitely. Okay, let's jump right in with SBEV, Splash Beverage. Wow, I mean, the numbers here are something else. 104% jump on the 15th.
Yeah, just incredible, and over 90% up in 2 weeks.
Right. It closed at $4.30 on the 16th, slipped a bit after hours to $4.05. What drives that kind of insane movement?
Well, usually something big. A major announcement, maybe earnings surprised massively, or just a huge sentiment shift. It's hard to say without digging deeper into the news for that specific day. But that kind of gain plus the follow-through suggests it's probably not nothing. The after-hours dip could just be profit-taking, people cashing in after a big run.
And the volatility is listed as over 54% on that last day. That's really high.
Extremely high. It tells you the price is swinging wildly. That's characteristic of this stock right now, it seems.
And analysts are noticing. They've upgraded it to strong buy, predicting, 124% rise in the next 3 months?
Yeah, I get this. A one-year target of $40.
$40.
Okay, wow. That sounds incredibly optimistic. What's the catch? More the fine print.
Well, the report itself flags it. They say there's a 90% chance the price will be somewhere between $1.63 and $7.36 in 3 months.
Ah, okay. That's a huge range. Exactly. That wide prediction interval screams uncertainty, even with the bullish calls. It's why it's also flagged as very high risk. Those Bollinger Bands they mentioned, they're wide, meaning lots of price scatter, lots of volatility.
Right. So the potential reward is high, but the potential downside also significant. They recommend a stop loss at $2.71.
Which tells you even the bulls see a point where you might need to cut your losses. It's not a sure thing by any means.
Makes sense. And technically, the moving averages are giving buy signals, both short and long term.
Yeah, those indicators suggest the underlying trend has been positive, reinforcing that momentum we saw. It all kind of feeds into that strong buy rating.
And the volume, 43 million shares traded on the 15th, worth over $120 million. That's massive volume, right?
Oh, absolutely. That kind of volume tends to validate the price move. It shows broad participation, lots of buying and selling. It wasn't just a few trades pushing the price artificially. Real interest there.
Okay. Let's shift gears a bit. STAK Inc., oil field equipment. Current price is $3.63. What's the initial picture here?
Well, the STAK is tied to the energy sector, right? Oil and gas. And the data shows they've hit a rough patch. Revenue down over 10% in 2024, earnings down almost 30%.
Oof. Not great numbers recently.
No. Suggests some industry headwinds or maybe company-specific issues? Or both?
But analysts still see some upside. A $5 one-year target. That's like a 30–40% gain potential?
Moderate growth potential, yeah. They also point out the PE ratio is low, 8.6 times earnings, compared to the broader U.S. market around 16.4.
And for you, the listener, that PE ratio, price to earnings, it kind of tells you how much investors are paying for each dollar the company makes. So lower is cheaper.
Sometimes. A low PE can mean it's undervalued, or it can mean investors are worried. Given the recent performance and the whole oil price roller coaster,
right,
that lower PE might reflect those risks. The market might be saying, yeah, it's cheap, but the future looks tough or uncertain. The $5 target suggests analysts think it's a bit too cheap, but those sector risks are absolutely key.
Okay, got it. Moving on to Webull Corporation. This one's been in the news. Post-SPAC merger. Price around $36.22.
Yeah, and talk about volatility again. A 500% spike right after the merger. That's wild.
Huge gains recently, too. 135% in the past week, 126% over the year. But yeah, that screams high volatility, like you said. What's the driver here? And maybe quickly explain SPACs again for folks.
Sure. A SPAC is basically a blank check company that's already public. It raises money, then finds a private company like Webull was, and merges with it, taking it public faster than a traditional IPO.
Gotcha.
That huge initial jump, often fueled by hype, speculation around the new public company. The gains since then suggest continued interest, but yeah, the volatility is intense, hitting an all-time high and low on the same day. April 11th. That tells you everything.
Wow. And analysts seem pretty bullish, too, targets between $40 and $50. But there's a warning note about global tariffs. How does that play in?
Right, that's the macro picture stepping in. Big economic stuff like tariffs creates uncertainty.
Yeah.
It can make investors nervous, more risk averse.
Even for a hot stock like this.
Especially for high growth, maybe higher risk stocks. When sentiment sours globally, even companies doing well individually can get dragged down. So those analyst targets, they look good, but external factors could definitely throw a wrench in the works, short term at least.
Makes sense. Okay, next up, XAGE, Longevity Health Holdings. This one looks different. Price is way down at $0.17 bioaesthetics sector.
Very different.
Yeah.
And extremely volatile, but in a different way. Look at this. Up 71% last week, up 63% in the last 24 hours.
Whoa.
But down 93% over the past year.
Ouch. Okay, so a penny stock with massive swings. High risk doesn't even begin to cover it, does it?
Not really.
Yeah.
That huge yearly drop suggests major problems historically or just a complete loss of investor confidence. The recent jumps are interesting, but off such a low base, it's highly speculative.
The report mentions a triple bottom pattern, suggesting a potential target of $2.23. That sounds almost unbelievable from 17 cents.
Yeah, that's a technical analysis pattern. For our listener, it sometimes suggests a trend reversal after a long downtrend.
But
Huge but. Technical patterns are much less reliable for these super low-priced, thinly traded, highly volatile stocks. The historical performance, that 93% drop, that's the dominant story here.
Right.
Relying on a chart pattern alone feels risky, very risky.
understood. It's operating in bioaesthetics, skin and hair health with a product called Carmel Secreto. Interesting area, but yeah, the stock history is concerning.
Definitely. Potential in the sector, maybe, but this specific stock looks like a long shot based on this data.
Okay, finally, VR or Venus Concept Inc. Medical aesthetics tech, price at $4.30, same as SBEV's close. What's the picture here? Looks like a mixed bag.
It does seem mixed. On the one hand, you've got recent analyst buy ratings suggesting some optimism. They did a reverse stock split back in February.
Which is when they reduce the number of shares to boost the price per share, right?
Exactly. Sometimes done to improve perception, maybe meet exchange listing requirements. But on the other hand, short interest is up significantly over 32%.
Meaning more investors are betting the price will fall.
Precisely. So you have analysts saying buy, but a growing number of traders betting against it.
Yeah.
That's conflicting sentiment right there.
Yet, despite that, the one-year target is $40. Same as SBEV's ambitious target.
Yeah, it's another very bullish target from analysts. Suggests they see massive potential. Maybe discounting the short interest or believing the company's strategy will work.
The report mentions some financial moves, debt for equity swap, direct offerings. What's the significance of those?
Well, swapping debt for equity cleans up the balance sheet, reduces debt load, which is generally good. Direct offerings, selling shares to institutions, bring in cash quickly.
So potentially good for funding growth.
Could be. Seen as steps to shore up finances. But offerings can also dilute existing shareholders, meaning each share represents a smaller piece of the company. So again, it's complex. Potential positives, but also potential drawbacks depending on the specifics.
Okay, so wrapping up our look at these five. Quite a range, isn't it? SBEV and Bulal, just explosive moves, super high volatility. STAK, more tied to its sector, moderate outlook. XAGE, highly speculative, big historical issues. And VERO, potential maybe, but with those conflicting signals.
Absolutely. It really shows the diversity within the market. Different sectors, different risk levels, different stories playing out. You can't paint them all with the same brush.
So for you, our listener, we hope this deep dive gave you a clearer snapshot based on that April 16th data. But please remember, the market changes constantly.
Constantly. What we talked about today isn't a prediction set in stone.
Right.
It's based on the info we had at that moment.
Yeah.
Future performance is never guaranteed.
And the key takeaway always is think about your situation, your own tolerance for risk, your financial goals.
What looks like a great opportunity to one person might be way too risky for someone else. Definitely do your own homework, dig deeper, and consider talking to a qualified financial advisor before making any decisions.
Couldn't agree more. So here's a final thought to leave you with. We saw these really different volatility levels, right? And these varying growth predictions, from the crazy swings of SBV or XAGE to the more maybe grounded situation with STAK. What factors do you find more compelling or maybe more concerning? Are you drawn to that high risk, potentially high reward scenario? Or does something with maybe slower, steadier potential seem more appealing in these industries? Something to chew on. Thanks for tuning in to the deep dive.
I am thrilled to offer you an opportunity to earn a significant return on your invested funds. If you loan me a 20,000 sum, I will personally ensure a 10% return every year, with the money automatically zelled back to you monthly for 2 years. This is a fantastic chance to grow your investment with minimal risk, as your funds will be returned every month without fail. When the Fear and Greed Index indicates extreme fear, it suggests that there's widespread pessimism and anxiety in the financial markets. This could be due to various factors like economic downturns, geopolitical tensions, or unexpected events that have caused investors to become increasingly cautious. During periods of extreme fear, market participants may withdraw their investments, leading to decreased market liquidity and potentially causing asset prices to fall significantly. Healthcare companies often move differently than the broader market. Shorting health companies specifically might not provide a sound hedge against overall market movements, since they tend to have their own dynamics and influences. So, using healthcare companies as a hedge might not yield as effective protection as expected. Shorting healthcare companies can be a risky endeavor. Here's why. 1. Regulatory environment. Healthcare companies often operate under stringent regulations with varying government policies. Regulatory changes can either boost or damage stock prices. If a new regulatory framework is favorable, it can significantly affect the share performance of these companies. 2. Market sentiment. Healthcare companies are often subject to unpredictable market sentiments and investor psychology. A rise in healthcare costs or a public health scare could lead to increased demand, which is favorable for these companies' stock prices. If you enjoyed this content, please like, subscribe, follow for more updates, and don't forget to sign up for the exclusive bonuses down below.
Listen up, traders, it's your lucky day. Quick gains insights is here to stay. Subscribe now, come join the fray. Financial wisdom will light your way. Join Quick Gains Insights today. Like this video, pave the way. Sign up in the description, no, without delay. 4,000 free insights today. Like this video, pave the way. Sign up in the description without delay. 4,000 free, let's slay.